So, Donald Trump just dropped a proposal that's got the financial world buzzing. He's talking about a 10% cap on credit card interest rates. In this explainer, we are going to break down what this could mean for your wallet, what it could mean for the banks, and maybe most importantly, can a president even do this?
Okay, just take a second and think about your own credit card statement. You know the rates. They're often 20, 25, maybe even higher. Now, just imagine that number was suddenly slashed all the way down to 10%. I mean, it sounds simple, right? But the fallout could be incredibly complex, and that's exactly what we're going to unpack.
And this number right here is why this conversation matters so much. Americans are carrying a truly staggering $1.23 trillion in credit card debt. That's according to the latest data from the New York Fed. And with the average APR hovering over 20%, the interest payments alone are just a massive, massive weight on household budgets.
So here's how we're going to tackle this. First, we'll look at the proposal itself. Then we'll ask, can the president actually pull this off? We'll dive into the upside. We're talking huge savings, but also the downside, the risk of a major credit crunch. And finally, we'll get to the bottom line.
All right, first things first. What did he actually say? Let's get right to the source. Now, the two most important words in that entire sentence are calling for. See, this isn't an executive order. It's not a legal command. It's a political statement, a powerful suggestion. And that distinction, that makes all the difference in whether this could ever become a reality.
Which, of course, leads us to the million-dollar question. Does a U.S. president even have the authority to single-handedly cap interest rates that are set by private banks?
Well, here's the legal reality. A president can make a public call, which is basically a really powerful suggestion. But to turn that into actual law, it has to go through Congress. A bill has to be written, debated, and passed by both the House and the Senate. The president simply can't do this with the stroke of a pen.
And critics, they jumped on this point right away. As Senator Elizabeth Warren pointed out, without Congress getting involved, the call is, in her words, essentially meaningless. It has to survive that whole legislative process to have any real legal teeth. Okay, but let's just put the how on the back burner for a second and focus on the what if. Let's say, hypothetically, a 10% cap did become law. What would the upside look like for the average person?
The potential savings are just, well, they're staggering. A study from Vanderbilt University estimated that a 10% cap could put $100 billion a year back into consumers' pockets. That's money that would have otherwise just vanished into interest payments.
So this Vanderbilt study really shows the trade-offs here. Look at how this savings just skyrocket as the cap gets lower, all the way up to that $100 billion mark at the 10% level. For households with debt, that's an average of $900 a month. But, and this is a big but, notice that last column. Banks aren't just going to eat that loss. They'd likely start cutting back on things like rewards programs. So you have to ask yourself, is an extra $900 a month worth giving up, say, your airline miles?
Of course, there's always another side to the story. What are the potential negative consequences? Well, industry groups and financial analysts have been raising some pretty serious alarms.
Billionaire investor Bill Ackman basically voiced the #1 fear in a tweet he later deleted. He argued that if banks can't charge rates that cover the risk of lending money, they'll just stop. They'll stop lending to riskier borrowers, and that could push millions of people out of the mainstream credit system altogether.
Yeah, the banking industry argues that a cap like this would set off a whole chain reaction. To make up for all that lost interest income, they'd have to get a lot stricter. This could mean way fewer people getting approved for cards, credit limits getting slashed, and all those perks we like, rewards programs, no annual fees, they could start to disappear as banks try to make up for the lost revenue. And you don't have to just take their word for it. Just look at how Wall Street reacted. It was swift and it was negative. As you can see, the stock prices for the big players like American Express and JP Chase took an immediate hit right after the proposal was announced. That tells you that investors believe a rate cap would directly hurt the bank's profitability, period. So we've seen the potential for massive savings, and we've seen the potential risks of a credit crunch. Let's try and bring it all together and figure out where things actually stand right now.
So what's the real bottom line? Well, for now, this is just a proposal. It is not a policy. And given the enormous hurdle of getting something like this through Congress, especially against what would be fierce opposition from the entire financial industry, most analysts think it's highly unlikely to ever become law.
And this whole thing brings us to the real takeaway. This whole debate over a 10% cap, it's not really just about interest rates. It's hitting a nerve because so many people feel like they're being crushed by the rising cost of living. Credit cards have basically become a financial band-aid for a much deeper wound. They're a symptom of the problem, not the solution.
Which leaves us with one last, really crucial question. Sure, a rate cap could offer immediate relief to millions of people, but does it fix any of the underlying reasons that people go into debt in the first place? Is this a potential cure, or is it just a painkiller for a much deeper economic issue? That right there is the real debate.